Hello, my fellow investment gurus, and welcome to this weekly update that we chose to move one day due to the US markets being closed yesterday, Monday. Alright, a lot has happened in the markets and geopolitically since last week, and I'll try and touch on most of it that we think is important. First of all, of course, let us just have a look at a little map here. I guess most of you are figuring out by now where Ukraine is, otherwise you better start looking at a map because Russia is doing a lot of meddling over here. There are some, if you remember back in 2014, they took this peninsula down here, and then of course there were some republics out here that Russia just acknowledged as you could call them rebel or independent republics, meaning that they can actually send forces in there to make sure the Russians in there are well and good. Now, it is difficult to say where all of this ends, but of course it affects the markets. However, not as much as you might think. So if we are taking a quick look here, first at the markets, you can see here that we have the Nasdaq index, and many people would had suspected that the market would really crash here today, but as we can see on the futures right now, the markets are actually moving into the positive territory. I know it fell some yesterday, the futures here, when the markets were closed, but actually Nasdaq has moved in positive since midnight here, and looking at the S&P 500, we can also see that it is not being completely crushed, which to some is a bit surprising. The oil is going up a bit, that is clear enough. If this conflict escalates between NATO and Russia, NATO will probably close down that Nord Stream 2 gas pipeline, which means that all of a sudden energy will explode in price, and that is of course something that will affect the market. So overall, the markets are actually not as badly hit as some commentators were afraid of. So the markets overall, the stock markets have been a bit down, or actually not just a bit, but 2 to 3% over the last week. But actually our models have started to bottom out a bit. If we're looking at first the weekly model, as you might recall, this is the model that I don't use personally, but that model is actually a tiny bit up over the last week, which is a lot better than the overall market. It is still down 21% year to date, so it's absolutely not a fantastic return. But the market only needs to turn a bit down here to the better, and then we can actually get quite a good return. As you can see, the first couple of months here have absolutely not been any fun to watch, and December not as well. But we can see on our testing that sometimes after a big dip, we get some really, really nice action. As you can see here, I know this wasn't the dip, but you can see here February last year, 17.5%. And we can also see we had a 10.5% here and 2 6%ers here. So it can quickly turn. But of course, this is a bit of a hard drawdown, a tough drawdown to stomach. Let's have a look at the momentum, monthly momentum here. That is quote unquote only down just below 17% this year. And again, we actually see a positive week last week here where we are moving slightly up from this overall max drawdown here. And as you can see, also these months are quite bad, but not as bad as a weekly, and that is one of the reasons why I'm not using the weekly. I think it is a bit too quickly reacting to my tasting. So the quarterly momentum about the same here. So we are hoping that this will actually be the start of some good move upwards. Now, how can I possibly talk about a move upwards when we are on the brink of war over here? Well, first of all, the markets has dropped. They have dropped a lot, and a lot of this war rhetoric over here, in my opinion, has been priced into the market. I know there's also the entire interest rate debate and so on. But basically, I think over the last couple of weeks, a lot of the focus have been on this eastern Ukraine, all the Russian war rhetoric over here. Also, the media has a war rhetoric, of course. So there's been a lot of talk about war. And often, if we look at some stats here, I know it might be a bit blurry, but I hope you can see it. I might just enhance it a bit here. As you can see, this is a list of different conflicts, crises, bombings, wars over the last 80 years. Whereas the worst one was the Pearl Harbor attack. When that happened in 41, I know we can't really compare the stock markets from back then and then today, but the total drawdown after that Pearl Harbor attack, the first day after, it went down 3.8%, and then the total drawdown was 19.8%. It bottomed out after 143 days and had a total recovery to break even in just shy of a year. And here we are talking Pearl Harbor, the beginning of the United States intervening in Second World War and so on. We can see North Korea invading South Korea back in 50, minus 5.5% here. Overall drawdown 12.9%. We can see some of the other Kennedy assassination. We can see there should be somewhere here, maybe the Cuba crisis. There are some bombing in Syria, North Korea missile crisis, and so on and so forth. You can see here, 6-day war, the 6-day war down in the Middle East, 1.5% drawdown. Here we have the Cuban missile crisis, minus 6.6% overall, and total recovery time 18 days. So this is kind of the history. I know that every conflict is different, and this is one of the first times since the Second World War that we have really seen this sort of war threat in Europe. And in the Cold War, there were also some instances, but basically, historically, war like this is not really anything that affects the market over the long term. So you can wonder why, and there are all sorts of explanations for this, but basically, if this conflict in Ukraine is contained to the eastern part of Ukraine, NATO will probably put some sanctions already today on Russia, and that will hit Russia hard. The Russian stock market is being hit hard, but overall, in Europe, in the United States, in the rest of the world, the world will go on, and people will realize that the companies will keep making money. Of course, some of the companies with exposure to Russia, to Ukraine, and so might be hit, but overall, life will go on. So let's have a look at the last two strategies here. We have the ETF strategy, which is a bit more conservative than the stock momentum strategies. It is down 11.5% this year. Also have done quite fairly here over the last week or so. And as we can see down here, again, it had a positive last quarter last year, which was more than you could say about many stock portfolios. And then we have started the year out here in the negative territory. But that is also a strategy that can easily move itself up. We have 10 months left of the year. And depending on how many crises and interest rate scares we have, we might actually end the year in positive. The last one, the ultimate dual momentum strategy here, if we're taking a look at that, we can see that is actually the best one so far this year, 9.25% here. We can see that it had its max drawdown here at the end of January and has been moving a bit up and down since then. But basically doing quite all right, and I think this one will also recover quite quickly when the market starts to recover. So right now, the markets are trying to figure out, is the conflict in Ukraine, is the maybe several interest hikes here just over the next quarter or two, are they priced into the market? And I have a feeling that we are close to a point where all of that scaring is priced into the market, meaning that it doesn't take as much for the market to start to move upwards. But let's see, there might be 5 or 10% extra to the downside in the market, but I think we are a lot closer to the bottom of the market than many investors and analysts expect to. But only time can tell. And let's hope that the next week will be even better than the one we have seen, and that we can slowly start to move into the positive territory. We have about a week left of the month, and as when we looked here, we can see that we are down 4.4% for the month. It is not completely unrealistic that we can get close to break even for February, but that depends a lot on how the market reacts to all the crisis talk right now. But let's see what happens. We're relying on the models. They have worked for us nicely over several years, and I suppose they will do so again this year. All right, that's all for now. I'll talk to you again shortly. Take care of yourself and your money out there, and we'll talk to you Wednesday or Thursday here with a new video. Bye for now.